Hello, everyone, and welcome back to our weekly tanker market podcast. I'm your host Trisha, and today we are going to discuss the latest trends and insights in the tanker market for week 51. With me today is Sandesh, our expert in crude, CPP, and LPG markets.
Hi Trisha, thank you so much for having me here today. I would like to wish a Merry Christmas to our audiences and you too. Thank you once again for inviting me.
Yes, Sandesh, a very Merry Christmas to you and all the listeners who are listening to our podcast. So, let's begin with the crude market first. So, how is the VLCC market performing lately? I've been hearing that despite the Christmas slowdown and North Asia's port closures, MEG saw a slight recovery last week. So, can you share what specific factors drove this improvement?
Sure, Trisha. The VLCC market for ex-MEG or the Middle East Gulf had a challenging start last week. The rates dropped below key thresholds because there weren't enough inquiries for cargoes. And at the same time, relates, these are vessels controlled by charterers that they decide to reoffer into the market and were willing to accept lower freight rates. This particular mechanism added more pressure on freight rates. And on top of that, there was an oversupply of tonnage, meaning there were too many vessels available. And in line to that, there weren't any enough cargoes available to move those particular tonnage. And this imbalance pushed rates down further. In addition to the same, I would also like to mention that this oversupply of tonnage is a kind of a situation we have seen in the last 3-4 weeks, specifically since the mid of November 2024, and it may continue because now Christmas and holidays are approaching and we may see decline in the cargo activities. Now moving ahead, like I have mentioned, the Christmas slowdown and the port closures in the North Asia, they also played a key role in the VLCC market. Those factors reduce the overall demand for shipping crude oil in the region. It's common to see less activity during the holidays, but this time it felt more pronounced. Because of all these reasons, the market was weak in the first half of the week. By midweek, however, there were some positive signs in the market. We saw some fixtures, those were happening at slightly improved rates, and this deal showed that demand was slowly picking up. But as the week progressed, towards the end of the week, owners started resisting the lower offers that were being made earlier. And overall, this resistance helped rates to improve slightly. It was specifically for the cargoes loading towards the end of the December weekends. And if I have to give examples, that is the benchmark routes, we have a Baltic TD2 and TD3C routes. These shipments, that is Middle East Gulf to key destinations in Asia, specifically in China, both increased by over 4%. TD2 closed the week at world scale 41.6 and TD3C settled at world scale 40.80. And these improvements reflect the small recovery we saw in the second half of the week. Now looking ahead, the market is now focused on January cargoes. We have seen some of the laycans already concluded. A lot will depend on how tonnage supply shapes up in the coming weeks. If there are fewer vessels available, owners might have more bargaining power to push rates higher. But if the oversupply continues, the market could remain under pressure. It's a delicate balance that we will need to watch closely.
Very rightly said, Sandesh. Now, shifting focus across both ex-WAF and ex-USG regions, I hear markets experienced challenges last week, with ex-WAF seeing recovery signs while ex-USG faced bearish sentiment. So, can you provide us some insights on what's really happening over there?
Trisha, West Africa playing a key role in the VLCC segment. So let's look at the West Africa or WAF segment. In the last week, it was started on a weak note, similarly like Middle East Gulf region, and the fixing activity was still subdued, meaning there weren't any enough cargoes present in the market in order to move, and it gives a lesser opportunity for owners for their freight. And on top of that, there was a long tonnage list, too many vessels available, and this oversupply made it difficult for the owners to push for higher rates. And as the week went on, rates continued to drop. There was a very limited visible activity, and much of the fixing that did happen was done off market. And this means that the deals were concluded privately. The eastbound shipments, specifically to Asia, particularly in China, Japan, and Korea, They were fixed below previous levels, and that drags the market down even further. And by the midweek, the rates in the region had fallen to their lowest point since October 2023, and it shows how weak the demand was. We can say that this demand is attributed to the fall due to Christmas holidays. And having said that, once we have moved ahead towards the end of the week, we saw some recovery, a gradual recovery, we can say that. There was an increased demand from the Middle East Gulf, which indirectly supported activity in the West Africa. The rise in the reported deals also helps stabilize the market, and it allows to recoup some of the earlier losses for the ship owners. While it wasn't a strong rebound, it was enough to bring a bit optimism back into the region. Now that's all about the West Africa. Let's talk about the VLCC market in the US Gulf or ex-USG. Early last week, we saw a burst of activity in the region. More cargoes were being quoted, and it created some hype and momentum in the market. However, despite the initial activity, rates started to soften as the week progressed, and fresh tests, which are new fixture concluded to the test current market level, were coming in below expectation. And by midweek, the market sentiment turned sluggish, and an oversupply of tonnage as well as lesser cargoes, they kept rates under pressure. Low cargo volumes only made things worse, and it leaves owners with limited bargaining power. And by the end of the last week, bearish sentiments dominated. The USG China route were trading lower, with rates falling between 6.35 million and 6.4 million lump sum basis, and it shows that how weak fundamentals are there in the region right now. So to summarize, overall ex-USG market remained under pressure, and without an increase in cargo volumes or a reduction in the tonnage list, it will be tough for rates to recover significantly in the near term.
That was a very helpful breakdown, Sandesh. The contrast between ex-WAF and ex-USG clearly shows how differing demand dynamics impact the market sentiment.
That's exactly right, Trisha. And actually, that was the thing we should look on in the future, how the market movement will impact further.
Well, now considering the recent performance of the Suezmax market, particularly in the ex-MEG and ex-WAF regions, could you tell us what factors contributed to the stable yet subdued market conditions?
Well, last week the Suezmax market had a mix of stable and weak trends across the regions, and in the Middle East Gulf, the week started on a steady note. And westbound routes, they were held firm, while eastbound routes showed some slight improvement due to more fixture for prompt laycans. However, eastbound routes remained weaker overall, even though vessel supply tightened slightly. Midweek, the market became quieter with fewer new cargo inquiries and too many vessels available, and it also impacted rates downwards. And as we move ahead in the week, by the end of the week, last week, westbound rates improved a bit, showing some positive movement. Meanwhile, eastbound rates stayed flat with limited demand and low market activity, and it leads to ongoing weak sentiment. And with the current trend, we may see that this particular sentiments will remain there by at least first week of next year. So talking about XYF, the market also started stable. It was supported by some activity in the US Gulf. But again, as the week progressed, demand for cargoes dropped, and the number of prompt vessels, they continue to grow. And along with the competition from VLCC taking Suezmax cargo tenders, it puts pressure on the market. The nearby regions like Mediterranean and Black Sea also supported the falling rates because it added a negative sentiments in the West Africa. And by the end of the last week, the market remained under pressure with fewer reported inquiries and more private deals happening behind the scenes. Now, if we have to look at the rates, the TD6, that is benchmark Black Sea to Mediterranean, it dropped by 5.31% to world scale 91.90. And TD20, which monitors West Africa to Europe routes, it fell by 8.31% and it settled at around world scale 80.28. And I also like to point out that I have not mentioned earlier, but for the audience, I would like to mention that the world scale 2025 those rates got updated, and these are already applicable in the current benchmark rates.
Well, thank you so much, Sandesh, for that update. And it looks like we'll have to wait and see how things progress for the Suezmax market. Now, since we have discussed about the VLCC and Suezmax markets, could you also provide a brief overview of how the Aframax segment performed?
Well, last week, Aframax market across both XMEG and XSEA, that is Southeast Asia regions, was quite slow. And in the XMEG, there was a limited demand and tight Aframax supply, and that caused the fluctuating rates and fixture reported below market expectations. The availability of ships for eastbound routes was limited, and it added more pressure on the market. Over in XSEA, that is Southeast Asia route, the demand consistently lagged behind the available supply, and it keeps market sentiment soft. And we believe that in the coming weeks it will getting softer. The benchmark route here, that is TD14, it dropped by 1.17% week on week, and it got settled at around world scale 116.5. And at the same time, the other benchmark route, that is TD8, it also fell by 2.58% week over week, and it got concluded at world scale 132.29. So both the regions continue to face challenges with the demand is getting lower and rates are keep coming under pressure.
Thank you, Sandesh. Now, let's shift our focus to the CPP market. How do you see the outlook for both the LR and MR markets, especially given the recent trends in freight rates?
Well, talking about the CPP market, for the LR market, we have seen the rates decline as there is very limited demand and older fleets that are struggling to remain competitive. However, the MR market is showing strong recovery with 8.55% increase in rates, and those were driven by greater activity and flexibility in handling shorter trade routes. As the MR segments grow, they benefit from more adaptable ships and strategic repositioning, and that helps to stabilize the market. Meanwhile, if we think from the global perspective, that is, those vessels, those are currently trading in the market. Overall, the LR market needs to address issues like aging vessel and shift in regionals supplies to regain momentum. Overall, while the LR market faces challenges, the MR market is expected to continue growing with the strong demand.
Now, Sandesh, given geopolitical tensions and decarbonization efforts, do you see regional factors like China's supply crunch impacting the future dynamics of the product tanker market?
Well, that's a great question, Trisha. Actually, the regional factors like China's supply crunch are important in shaping global trade patterns. The Chinese refineries, those face difficulties with the reduced Iranian crude and logistical issues. But there is a shift towards alternative supplies like Indian and Saudi Arabian refineries. What that mean? That means that if European companies, those are getting Chinese material or Chinese petroleum product, and if China is not able to produce that significant amount of product, then India and Saudi Arabia will ultimately get the market share. And India kind of leads in the supporting petroleum products to Europe because they have a favorable product available in the market. So this shift it combines with increased demand for LPG and petrochemical products, and it indicates a more diverse product tanker market where regional factors will play a significant role in balancing supply and demand. And this is from the Chinese domestic demand and supply point of view. So these changes are likely to push tanker owners to adapt quickly to new trade patterns, and they may take advantage of the growing complexity in the regional market.
That's an insightful perspective, Sandesh. It truly highlights how regional factors are becoming increasingly influential. Now, turning our focus to the LPG market, I hear the east of Suez market saw a significant increase last week. So, can you tell us more about what drove this surge?
Yes, last week the east of Suez market saw a significant rise, and one main factor was the limited availability of vessels, specifically in the Arabian Gulf, and it was before the January 10th. This caused a tight supply situation and it pushes the rates higher. Additionally, if I have to say the Indian demand, it is expected in the first 10 days of January, and it played a key role in boosting sentiments. Now, rates on the Ras Tanura Chiba route, that is the benchmark route for LPG trade flow, it jumped nearly 30% since mid-November, and it shows a strong demand. Now, talking about the Western markets, the USG Indonesia fixture was initially agreed at $105 metric ton, but it was a below market expectation. However, the rates have since recovered to $110 per metric ton, that is the $5 per metric ton growth, and thus it shows some improvement in the market, specifically the sentiments towards this particular route. And having said that, the in the west, the transatlantic rates, they have stayed steady at $61 per metric ton, and even though a few end January traders, relates, and two owner controlled vessels are still available in the market, vessel availability remains tight, and especially moving into February. And that says the tight supply could continue pushing rates higher if demand stays strong.
Thank you so much, Sandesh, for sharing your thoughts.
Thanks, Trisha, for inviting me once again. And to our audience, once again, wish you a Merry Christmas. Stay healthy, stay happy.
And I guess that wraps today's episode. To all our listeners, thank you so much for tuning in to our episodes. Until next time, navigate safely and